because I know how hard it is. We know how hard it is to work and save that money and trust into a system where you think that they're doing right by you, but we don't even have financial education in our school systems, which is a whole nother different topic. But now we got to figure it out, and we want to make sure that it lasts.
Yep, so let's talk about the solution. And I want everybody to really tune in because we're gonna explain exactly what a fixed indexed annuity is.
So what a fixed index annuity is and what it does for you is, number one, it protects your money 100%. All right, so that means the IRS allows you to move your money in two instances, whether you no longer work for a company or you are now 59 and a half. And you can move that money tax-free and without penalty from one retirement account to another retirement account. And that is what an annuity is. It is a retirement account between you and the insurance company, and you own it. Not the employer that you work for, not one of the big box brands that run the retirement companies. You own your retirement. Number two, it allows growth. Right? Growth that you can get from the market.
Yes.
But you know what's so great about that growth from the market, Jasmine?
What?
There's no losses.
There
is no losses in an annuity, and a fixed index annuity specifically, because the insurance company guarantees that in this annuity, you're protected from losses. Your floor is zero. Number three is that you will receive a payment for the rest of your life. Let me say that again. You will receive a payment monthly for the rest of your life. A 401k can't guarantee that.
So I want to quickly talk about, I know we explained what a fixed indexed annuity is and the two problems that it solves, but I want to talk about the three different ways that your money can grow. Because in order for us to find value in what a fixed indexed annuity is, you gotta know the difference between a fixed vehicle and an indexed vehicle. So there are three ways that your money can grow. Number one is fixed. And what are fixed accounts?
Fixed accounts are your bank accounts, your CDs, your savings. We call this no growth to snail growth, right? It's just real slow. Tick, 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 tick. But you know it's going to be there, it's protected, but it's not really explosive.
Yep. So what's the benefit of a fixed account? It's safe. How do we know that? We love putting our money in the banks because it's FDIC insured up to $250,000. What don't we like about fixed accounts? As my husband was just sharing, the growth runs as fast as a turtle. Very, very slow. 0% to 0.0001%. So that's a fixed account. The second type of account where your money can grow is a variable account. And variable accounts are individual stocks, real estate, your 401k, right? What do we love about variable accounts? Because there's something to like about them, is the growth. How many of you love when the stock market is performing up? So then you have index accounts. Index accounts give you the best of both worlds. It gives you safety. You never have to worry about losing a penny from your principal, but it also gives you that growth. So whenever the market is up, that interest is then compounded with your principal. Let's talk about the four homes of money. So where do we put our money, Ellis?
Where do we put our money? Well, we typically put our money in one of three places. Most Americans, it's the four homes, right? But typically we put it in one of three.
Well, let's explain it like this, babe. I have $10,000.
All right.
Right now I have $10,000. What do I do with it? What are my options?
Well, first off, typically people put their money in a bank, right?
And it makes sense?
Yeah, and then if they say, okay, I don't want it just to sit, because most people don't understand. Well, people want to make more money, right? So if it's not making money in the bank, we got to put it somewhere else. And so someone will say, okay, well, maybe I'll buy real estate, right? So that's our second home. And if they say, well, okay, if I don't want to put it in real estate, then my only other place is to put it in the stock market. So most Americans' money is in one of three places: the bank, the stock market, or real estate.
So let's talk about the laser test. So let's put those 3 homes of money, because we haven't unveiled the 4th home yet.
That's right.
So let's put those 3 homes of money through the laser test.
All right.
So number 1, the L is for liquidity. And basically, liquidity is when you want your money, you can go get it. If I deposit $20 in the bank today, guess what? I can take out $20 out of the bank. It's liquid. I can touch it when I need it. So that's the banks. So the banks actually pass the liquidity test.
They do.
What about the stock market?
Not liquid at all, right? You put your money in and it's wrapped up into a index, a market, whatever the case may be, and you have to wait till the day is over, sell it, and then there's a process if you want to get it, and hopefully you didn't lose it.
Bingo. Yeah,
Right?
there are actual rules, guidelines, and regulations that stipulate when I can get my money when it's in the stock market.
That's right.
Right? And then the 3rd home that you unveiled, real estate. How liquid is real estate?
It's not liquid at all, right? We purchase a home today for $100,000, a building, a property, whatever the case may be. Is it worth that same tomorrow, right? And I know real estate people say, hey, I can go get me an equity line of credit, this, that, and the third, but that's a process. It's not quick. It's not liquid. So it does not pass the liquid test.
Bingo. Well, consumers need to know that, yes, you can build equity in a real estate purchase, but typically it doesn't happen overnight.
It's not immediate.
Typically it takes years to really build up significant equity into that home, right? And so then you have right? So the real estate does not pass the liquid test, neither does the stock market, but banks does. Okay.
That's right.
So now let's talk about the next letter in the laser test, which is the S.
Safety.
Safety. All right, how safe is your money? So let's explore banks. Now, we all love putting our money in banks because not only is it liquid, not only can I go deposit money or withdraw money when I want to, but we love seeing these 4 letters, FDIC. It's insured. Our money is backed by the Federal Reserve up to $250,000.
That's right. Each account that you have is up to $250.
So it's safe. So banks actually have passed 2 out of 2 in the laser test.
Yes, it has.
So what about stock market?
Well, you tell me. You put your money in, is it going to be there tomorrow? Well, what we've seen with COVID, the beginning of 2022, this year so far, stocks right now are just not passing that safety test. Right? My money up and down every day, if you have all of your savings into it, can be a complete nightmare.
Yeah, economists actually report that the stock market's first 6 months of 2022 was the worst half of any year since 1970.
The next home, right?
Yep.
Real estate.
Yep.
Is real estate safe?
We can ask the millions of Americans who foreclosed on their homes in 2008.
2008, 2009. During the pandemic, people lost their jobs. People went into foreclosures. So the answer is really no. And then also housing value went down, right? And so it's much harder now for people to be able to grow that equity in a home. You really have to have really long-term vision to grow an equity in a home right now.
Yep. And then the next category in the laser test is taxes.
So you forgot our rate of return.
Yes. Rate of return. Do rate of return.
So we got our rate of return. So in the bank, do we make any money in the bank? No. We don't make any money. We don't make any money in the bank, right? But in the next home, in the stock market, can you make a lot of money?
Yes, you can.
Can you lose a lot of money?
Yes, you can.
So you play that cat and mouse game of buy low, sell high, but the average American doesn't have time to watch the market every day to buy low and then sell high, right? So that's the problem with the market. And then the next one in real estate is the same thing, as a matter of fact, of the market, because I can buy my house low today. Will it be high tomorrow? I'm not sure. It can actually go underneath. It can go under, right? So you can lose value in your home.
And then the final one is taxes. All right. So we can quickly put the banks, stock market, and real estate through the tax test.
Taxes in the bank. Well, there are no taxes in the bank because you don't make any money, so there's no capital gains, right? The stock market, you got to pay capital gains tax, so it's not tax-free or tax advantage. And then owning a home, well, if for you, a consumer, you buy a home, yes, you can get some tax advantages. But if you're in real estate investment, then no, there's not, right? There's not many tax advantages to that.
Yep.
And so that's the laser test for the 3 homes, right?
The 3 homes. So we've gone through liquidity, safety, rate of return, and tax benefits for banks, stock market, and then real estate. And then there's a final home. The life insurance industry passes the liquidity. You can get your money when you want it.
Yeah.
Guaranteed safety, guaranteed principal protection, a rate of return that beats banks every day, all day.
There you go.
And it's tax-free.
That's right.
Who wouldn't want to put their money in the life insurance industry? Well, that's why we do what we do, so that we can equip you with the knowledge, skills, and ability to live a life of prosperity and purpose and build wealth for your own family.
Absolutely.